to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate and do some teaching. Call me 1-800-743-CNBC. Tweet me at Jim Cramer. When you get a strong employment report like we did this morning, it does a lot of things that you need to know about. First, it takes a near-term recession kind of off the table. Very difficult to have a recession with 4.2% unemployment rate. That's just too much to bear for workers. Second, it tends to discourage the Fed from cutting rates, which matters because they meet next week. Third, it can cause an explosive rally as long as wage growth isn't too hot. And that's why the Dow roared 564 points today. S&P shot up 1.47%. Nasdaq pole vaulted 1.51%.
House of pleasure.
We get so many different numbers out from the government, but none are more important than the labor report. That is the real predictive power when it comes to the stock market. So keep in mind that today's rally may not be one-off as we go through our game plan for next week. But first, let me just say we're over the hump. We've now had companies that reported fabulous numbers like Microsoft and Meta, good numbers like Amazon that I think will get terrific as the year goes on, which is why I say you buy Amazon, but also some strong numbers that could become problematic unless the tariffs get brought down soon. And that's what we heard from Apple. Now, we're not waiting until Monday to start the plan here. The market was up in the morning, but then accelerated higher when we heard that the Chinese were debating a peace offering involving a crackdown on fentanyl. If that comes true, I expect this rally will have legs. Plus, tomorrow, beginning at 8:30 a.m. on CNBC, we have full coverage of something I know you'll want to watch, the always upbeat Berkshire Hathaway annual meeting. Becky Quick and Mike Santoli will bring you wall-to-wall coverage of Warren Buffett and his beloved supporters and shareholders. I don't know if you caught any of the stuff that they were doing today, but both Michael and Becky are really on their game on this one. It's going to be exciting. Oh, by the way, don't change the channel when it's over. Why? Because we're re-airing our Mad Money 20 doc after the Berkshire Hathaway coverage, 2:30 Eastern. Now, Monday's key earnings start after the bell. We're going to see what Ford Motor reports in the morning. Now, I have to tell you, I'm a little concerned here. Ford has worked hard to try to mitigate the tariffs, even as they're the most American of American automakers when it comes to content. Maybe they can break their streak of so-so quarters. I really hope so. I think Jim Farley deserves a break himself. The ultimate meme stock for the moment is this company called Palantir, which reports it's a cybersecurity company. Now, this one is moved up by persistent retail buying that starts around 4 a.m. every day, when they literally walk it up a couple of points before the bell and then continue to keep it at that level until the close. It's possible the story's not as big as the hype or the hope, but we know that Palantir's got a constituency of retail buyers that just won't quit. I don't know if they'll quit when they see the number. We also get numbers from Vertex Pharma, including the first look at how its non-opioid painkiller is doing. That's the one that's not addictive. The numbers could be explosive here because the drug is revolutionary. Now, Clorox reports, too. This is the kind of recession-proof stock that was going up when the rest of the market was getting hammered. But now that the market's bouncing back, they've all folded with the exception of Coca-Cola and Mondelez. Use Clorox as a gauge to see if this new bull market phase remains on. Tuesday? All right. We find out if the travel bull market's still alive when we hear from Marriott. Now, this incredibly resilient stock typically goes down after reports, and then it rockets higher. Same session. I think we'll think twice about the end of the travel rally when Marriott reignites the chatter. It's going to be a good number. After the close, we want to hear great things about demand from advanced micro devices, AMD. Perhaps we get the news that AMD is selling that manufacturing part of the ZT Systems. That's a company they acquired for $4.9 billion in cash and stock in March. Now, that could give this stock a lot of juice. Arista Networks is a crucial part of the data centers. It reports, and last time the data surfaced immediately, claiming that these guys were losing share. I think Arista can put those doubts to rest when it's, honestly, they can. And that means it's a buy ahead of the quarter. Never count out CEO Jayshree Ullal. Big mistake. Think about buying Arista. We went to see Wynn Resorts when we were out in Vegas recently, and I know the stock's been under some pressure. I'd love to hear that the negativity is all hot air. Don't forget that Jensen Huang, the CEO of NVIDIA, will be joining ServiceNow CEO Bill McDermott at the latter's Knowledge Conference. Jensen's a good partner at Bill's, and we might get news about how the government and NVIDIA are working together to solve some of these export issues. The meeting could certainly help the stock of ServiceNow, which has been a rocket ship since reporting it fantastic quarter. Lots of fireworks on Wednesday. We start with Disney. So many doubters. I think too many doubters and not enough supporters. We own this country and play for the Charitable Trust. We have not made money in it. It has not been good to us. I hope it gets good. Hope shouldn't be part of the equation, but I'm just telling you as I see it. Next, did Novo Nordisk deliver a knockout punch to Eli Lilly when it signed a deal to be the preferred GLP-1 supplier to CVS on Lilly's earnings day, no less? What a comeuppance. I think there's plenty of gas in the Lilly tank, especially once it tells it's, once it's got this pill formulation, that's going to be available next year. I think it's going to matter tremendously. We've come to expect that Uber trades down after reports, and you've got to buy the rideshare king because it's got so much going for it worldwide. I bet that plays out again, just like Marriott. Stock reports, stock gets hit, got to buy it. In the afternoon, we're going to hear from Fed Chief Jay Powell and get the verdict from the Open Market Committee about what they're doing with interest rates now that the tariffs are here. Tough spot for Jay Powell because we've had plenty of soft numbers, but today's all-powerful employment report wasn't one of them. Will Powell mention that the president's been frosty of late? No, but the press will. The man will demur. He's too smart to do anything else. After the close, we got a couple of companies that have caught the fancy of younger viewers, DoorDash and Dutch Bros. I expect both to have very strong quarters that can send their stocks higher. We'll have the inevitable comparisons between Dutch Bros and Starbucks. All I can say is that the Bros have the edge right now, but I like them both. And I don't know, did you see Starbucks starting to move up here? What else? Can ARM Holdings mount a comeback without strong cell phone sales? I think the year when we realize this is it. This is the year we realize that ARM's in everything and deserves a higher price earnings multiple. We also get results from one of the most heavily shorted stocks in the universe, Carvana. And I think they'll be able to talk about how tariffs will drive shoppers to their digital used car platform as new tarified cars, I made that word like tarified, it's really tariffed, could become too expensive. It could be an explosive report for Carvana. Thursday, we get Shopify's numbers. Here's another stock that tends to sell off on good news and then rallies when people parse it out and realize that, wow, this company's more than just a poor man's Amazon. After the close, we get a report from still another heavily shorted stock. That's a firm. That's a buy now, pay later story that has delivered some incredible results to date. I suspect the streak will continue. Two winners after the close. McKesson, the ultimate drug middleman with the target on its back that's never been hit. And Cloudflare, yes, the cybersecurity firm brought to you by Matthew Prince, who gave you a superb number last time, remember? I bet he can do it again. Will DraftKings make a comeback here? We like this company very much, but the stock does seem stalled, doesn't it? Maybe it needs more states to legalize sports betting. Nothing important Friday, but after still one more week of grueling earnings, let me just tell you, I think we deserve a day off. Here's the bottom line. We know that we're living through a time of great tumult. We could easily be thrown off if President Trump responds harshly to this Chinese olive branch this very weekend. If that happens, there could be some unwinding to do. Right now, though, it looks like the momentum can keep up as long as we don't get a total breakdown in the nascent trade talks between the world's two biggest nations. Let's start with Peter in Maryland. Peter.
Thank you for taking my call, and congratulations on your 20 years on Mad Money.
Oh, thank you, Peter. Really appreciate that.
As you know, Elliott Management has taken a large position on Phillips 66 and has nominated a separate slate of directors. Their principal plan seems to be to sell off assets to focus the company on its primary business. I'm concerned that selling assets will weaken the company's future prospects. So I have a two-part question. Do you have an opinion on whether to vote for the company's slate or for Elliott Management? And is Phillips 66 a good investment?
All right, let's just view it as an investment situation. It's got a 4.4% yield. We're running short of refiners. I think that the stock has been overly punished. It's been going down as if it's an oil stock. It is not an oil stock. It's a refiner, and I would be a buyer of PSX. And I've been waiting to say that for some time, but it's down enough that I think it's time. Paul in Oregon. Paul.
Hey, Jimmy, I want to thank you for all the years I've followed you on TV from way back when you were hanging around with Larry Kudlow.
Ooh.
And I'm currently in Investors Club, and I love you, watch you every day. I'm really hurting right now. I'm in a world of pain and a house of serious pain. In regard to a software stock, on one of the networks that was touted to be last year, the stock of the year for 2025. Now, all the research I did on it said it's a buy. I bought it back when it was about 190. I just hit it wrong. Currently has a P/E ratio of 35 to 1. But it's down to 20% when I bought it. It should be tariff resistant. It's slowly coming back, but it's had a lot of hemorrhage. I need some analgesia from it, Jim. I'm in a lot of pain. What's happening with Oracle, and why are we stuck in the mud?
Last quarter was not good. Okay? But I think the stock started to show you something today. I think it showed you that if you get a better tape and a better tech tape, you're going to make some money in Oracle. I urge you to hold on. Would I be a buyer? Yes. Right now, it looks like this period of rallying could keep up next week. That is, unless there's a breakdown of these rumored trade talks. Yeah, tonight, medtech player Becton Dickinson is trading at its lowest level in years. I'm seeing this decline as a buying opportunity, or maybe a sign to steer clear. Then could Shake Shack grill up some more gains despite some misses on its quarter? I'm looking at the reasons for the rally in this bun in a million. And later, don't miss my exclusive with utilities player Exelon to hear how the company's navigating tariff turbulence. And stay with Cramer!
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Yesterday morning, we got a very disappointing quarter from Becton Dickinson, the medical technology play. It sent its stock down 18% to its lowest level in 8 years. Everybody's giving up on this one. But I think actually you might be getting a real buying opportunity in a company that has the potential to turn itself around. Listen to me. For decades, Becton Dickinson was a fantastic growth stock. I mean, it was just incredible. It's a name I love to recommend here. Why? It's so reliable. Over the past 5 years, though, the stock had leveled off, mostly trading sideways with the occasional strong rally, but just as many sharp pullbacks. We actually spoke to CEO Tom Poland about 15 months ago. He told a pretty darn good story. In fact, Becton Dickinson delivered a series of strong beat and raised quarters last year. The stock never got any traction. The stock finally started to rally this January and February, especially after we learned that the smart activist investors at Starboard Value had taken a big position. And by the way, they were urging Becton Dickinson to sell its life sciences division. 2 days later, Becton Dickinson basically said, okay, let's do it, announcing the spin off of its life sciences division to unlock some value. I think it's a really smart move because the core medical technology business would be worth a lot more once it separates from the slow and steady segment. Unfortunately, alongside that announcement, management also issued what I guess you can call mixed guidance. Though the reported quarter had gone pretty well, they cut their full-year revenue forecast pretty substantially, and the stock tumbled 7% in response. After that, Becton Dickinson held up okay throughout the rest of February and March, even as the broader market started breaking down. But when the Liberation Day tariffs were announced, the stock tumbled 8% over the next 2 days. Even though the rest of the markets bounced back substantially since then, Becton Dickinson, it never recovered. That leads me to yesterday's earnings report. Even though I think the stock's now worth buying on weakness, let me be crystal clear. That quarter was distinctly suboptimal. Becton Dickinson gave you a meaningful revenue miss paired with a slight earnings beat, but more important, they cut their full-year forecast. First, management cut their organic revenue growth outlook by a percentage point from the previous 4 to 4.5% range down to the 3 to 3.5% range. Analysts were looking for 3.6. Then Becton Dickinson said the tariffs will shave 25 cents off their full-year earnings, which is not huge, but also not good. More important, the market simply hated this update. No less than 6 analysts have downgraded the stock over the past 2 days. Sell. 3 intraday yesterday and 3 more overnight. It was just so hideous. All 6 took the stock from the equivalent of a buy rating to the equivalent of a hold or neutral, with the downgrading analysts all basically sounding exasperated about yet another negative revision from management. It was visceral. I think it was like visceral negativity. It's not the particular forecast cut was so terrible. When you read through the numerous downgrades, there's a consistent message. While Becton Dickinson has disappointed investors for several years now, this year was supposed to be different. Coming into 2025, management had said they'd be guiding conservatively, essentially keeping the numbers low to ensure they could beat their own forecast. They wanted to underpromise. But now here we are, getting yet another downward revision. And the sellers just said, enough, get this stock off my sheet. People just ran out of patience, and they ran out of Becton Dickinson. Sell. I'm not going to tell you that these analysts were wrong to downgrade. No, not at all. Or that investors were wrong to sell the stock. I get their frustration, but I simply think that the total give-up moment by Wall Street might represent a darkest before dawn moment for Becton Dickinson. Anyone who has had high hopes for the company is now thrown in the towel, sold the stock, and that makes it much safer to own. Sure, it is disappointing that Becton Dickinson hit us with yet another guide down after already saying they'd given us a lowball forecast, but there were some pretty significant extenuating circumstances. When Becton Dickinson committed to guiding conservatively, how could they have known that to be a total upheaval of world trade? The company said specifically that, quote, before the impact of tariffs, the company expects adjusted diluted earnings per share to be consistent with the previously issued guidance, end quote, noting that, quote, strong operational performance driven largely by margin improvement is enabling the company to fully offset the earnings impact from its updated organic revenue growth expectations, end quote. Basically, even though Becton Dickinson lowered its organic revenue growth outlook a touch, management still says they would have been able to make their earnings guidance if not for Trump's tariffs. And look, they think tariffs will cost them only about 25 cents per share this year, when they were previously looking to earn $14.30 to $14.60 per share. All right, not a big hit. It was the exasperation that they kept cutting their guidance that bothered so many of these analysts. Hey, by the way, for all the commentary about missed expectations, Becton Dickinson has now beaten Wall Street's earnings expectation for 6 consecutive quarters. Their sales and earnings have been growing steadily over the past 2 years, and they're on track to grow nicely this year. So how disappointing is that? I don't know. More importantly, I like the stock at these levels because it's gotten incredibly inexpensive. Becton Dickinson now sells at an extraordinary 12 times this year's earnings estimates. That is absurdly cheap for a high-quality company. When you look at the average valuation over the past 10 years, Becton Dickinson typically is traded at a little less than 20 times earnings. For what it's worth, a stock also supports a decent dividend, or 2.5%. Company's a regular repurchaser of its own shares. They've already bought back $750 million worth of stock through the first 6 months of their 2025 fiscal year. Then there's the last thing, and this is the thing I really like. Starboard Value's gotten involved, and they're a very smart activist firm. I think they're very thoughtful. They pushed for a life science spinoff, and Becton Dickinson agreed to do it practically overnight. Management says that's still on schedule. That's really important. I like the breakup, and just as important, I like that a sharp firm like Starboard's gotten involved, not running. They think these guys can do it. They can keep management on their toes. Maybe Starboard will have to do more work than it previously thought it would. Look, maybe there needs to be a discussion about whether the company has the right leadership in place, which Starboard wasn't talking about previously. But I think their presence certainly makes, well, let's just say it ensures that the company gets back on track by any means necessary. That's how I felt. So here's the bottom line here with Becton Dickinson. It got wrecked this week, collapsing after the company reported a mixed quarter and cut its full-year earnings guidance. But I think this could be a buying opportunity, not a selling opportunity, as long as you're willing to embrace what I call a fireman trade, where you run into a burning building rather than run out of it like everybody else. Becton Dickinson's just too cheap to ignore here. The core business is fine. They can unlock a lot of value with this life sciences spinoff. To me, the stock looks like a buy, not a sell. Let's go to Ann in Indiana. Ann.
Well, for the millionth time, congratulations on your 20th anniversary.
Thank you so much, Ann. Thank you.
It's been so much fun this week.
Thank you. It's been a long time, but it doesn't feel like it. Thank you.
Oh, my God. It puts tears in my eyes. Thank you. So happy for you.
Wow. Thank you.
So, another dumb question, but who cares?
No dumb question. Come on.
Why specifically is Abbott's forward PE so much higher than their current or trailing PE?
Okay, their forward PE shows that there's going to be a pretty much of an earnings explosion, and I think a lot of that's going to come from Libra, which is their diabetes. They have the best diabetes device. It's cheaper than everybody's. By the way, I think pound for pound it's better than Dexcom, and Dexcom stock was up very big today. Also, remember, Robert Ford runs Abbott, and he runs it incredibly well. And I also think they're going to settle these lawsuits or win the lawsuits that have really kept the lid on the stock, and that's going to happen in 2025. But thank you for the kudos. I really appreciate it, and good to talk to you. Becton Dickinson might seem like a fireman trade, but right here, I think it really is too cheap to ignore. You got to take a look at this one. Much more made on it, including my post-earnings analysis on Shake Shack. Then, could power player Exelon see more growth ahead? Stock's up 24% this year. I've got an exclusive look at the company's top brass. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. perhaps you could have seen today's rally coming because earnings season's been signaling that we've gotten too negative. Over and over, we've seen stocks roar in underwhelming numbers. That's a classic sign of excess pessimism. Take Shake Shack, which reported a not-so-hot quarter yesterday. Still saw its stock rally 1% on the news before jumping over 6% in today's session. Now, look, when a stock rallies in subpar numbers, you know what that means. It means it's bottomed. Yesterday, Shake Shack delivered a modest revenue miss with 0.2% same-store sales growth. Wall Street was looking for 2.3% gain. 2-cent earnings miss off a 16-cent basis. Worse, management trimmed the full-year revenue and comp forecast. That's definitely nothing to write home about. Now, when those numbers crossed the wire yesterday morning, the stock instantly fell nearly 6%, $6, almost 7% in pre-market trading. It was incredible. Totally justifiable given the headline numbers. But in retrospect, you were really smarting if you made those sales because the stock quickly caught a bid. By the time the market opened, Shake Shack, it was in positive territory. So what turned things around given the fact that it was a pretty bad miss? Well, for starters, Shake Shack missed estimates for several key metrics, but there were some positives in there, too. The company's restaurant-level profit margins came in at 20.7%. That's up about 120 basis points year over year. Not shabby. 30 basis points higher than expected. They're benefiting from falling food and paper costs and plummeting labor costs as the company's now optimized their new hourly labor model, which provides more efficient staffing options, and they've gotten more efficient with their throughput. Plus, while management lowered some aspects of their full-year outlook, well, this was more mixed than negative. Shake Shack raised their full-year restaurant profit margin outlook from 22 to 22.5%. Even with softer sales, they see margins continuing to tick higher. Even better, management raised their 3-year restaurant-level profit margin forecast pretty substantially. They're talking about 50 basis points of margin expansion each year, and I love a 3-year. How great is that? But margins weren't the only bright spot of the quarter. There was a lot of encouraging commentary on the conference call. While traffic remained negative last quarter, management sounds confident that this is temporary. A lot of it came down to bad weather in some of the biggest markets. We know that happened. Shake Shack started off the year strong in January, but February proved to be the most challenging month. And again, that was because of the weather. There was some recovery in March, but April same-store sales were still down 1%. However, management said that momentum picked up as April progressed. They were seeing positive low single-digit same-store sales growth in the last few weeks. So we had good cadence. The most important part of the call was management's acknowledgement of maybe the biggest problem facing the industry: high prices for the consumer after years of elevated inflation. You know, this one reminded me of what we've been hearing from Kevin Hochman, the CEO of Brinker. That's the parent of Chili's, which turned itself around by emphasizing value offerings, giving people great bargains. As previous price increases rolled off, Shake Shack exited the quarter with less than 2% menu pricing increases compared to last year. Although it's been years since the company implemented such a small price increase, management believes keeping prices in check will give them an edge over the competition. The company also plans to ramp up its limited-time offer innovation. Shake Shack placed some of the blame for the subpar traffic last quarter on the fact that their Black Truffle Burger, LTO, limited time, had been running for several months. Well, for 7 months. The lack of new menu items meant less buzz to attract customers. I mean, can you really call something that's been around 7 months a limited-time offer? It was last summer through the past Easter. By the way, Shake Shack's new limited-time offer launched today, featuring a full barbecue menu. I hope it's successful, but I also hope it's pulled sooner than that. And it's not just burgers. Shake Shack saw strong success with, here's a wild one, its recent Dubai chocolate pistachio shake, which went viral on social media and sold out within minutes of its launch in mid-April at some locations. Very lucrative because their shakes come in at a premium price. Given the Dubai chocolate shake was priced at $8.49, I mean,
the House of Pain.
The highest price point for a shake they've ever offered? That tells me there's plenty of demand for the stuff as long as it's good. Personally, I'd opt for a $9.99 combo deal, but it's clear that the customers responding to these new products. What else? Shake Shack CEO Rob Lynch, a restaurant industry veteran who served a stint as VP of marketing at Taco Bell. That's what a launch point that has been. Pointed out that Taco Bell can make 450,000 different items out of just 14 ingredients with minimal impact on operations. He also helped engineer a turnaround at Papa John's from 2019 until May of last year when he moved to Shake Shack. After speaking with him late last year, I'm confident he can make it work at Shake Shack too. With value offerings on one side, premium items on the other, this approach sounds like a lot like the barbell strategy that Chili's has had so much success with. Management noted that they're on track with their plans to reduce their cost to build new locations by at least 10% this year, despite tariff and construction concerns. That's pretty cheap. Starbucks wasn't able to talk about it being that cheap. They also raised their full-year outlook for new unit openings slightly, bringing it up to 45 to 50 locations, with most of these new units coming online in areas of strength, like the Southeast, the Southwest. While Shake Shack still has a long way to go to reach their goal of 1,500 company-owned locations, more than quadruple its current footprint. That means this regional and national growth story won't exhaust itself anytime soon. Ooh, I really like that. Here's the bottom line. Shake Shack's quarter came up short on several key metrics, but the stock still managed to rally, in part because it was already down so much, but also because their margins are improving and management got countless growth initiatives going. You know what? I think this is a very compelling story. Look, you may want to wait for a better entry point after today being up 6%, but I got to tell you, Shake Shack, it's here, it's bottom. I like it. Mad Money's back after the break.
Coming up, can this stock power higher? Cramer's catching up with the CEO of electric utility company Exelon and seeing what's charging its recent gains. Next.
Boy, this has been a great year for utilities. Classic recession-proof stocks that also benefit from the big data center build-out because we simply don't generate enough electricity in this country to power all of these new AI applications. Look at Exelon, the parent company of a handful of major utilities in the Mid-Atlantic and the Midwest. From the end of last year through the end of April, this stock rallied nearly 25%, vastly outperforming the S&P 500. And yesterday morning, the company reported a rock-solid first quarter. So let's take a close look with Calvin Butler, the president and CEO of Exelon Corp, to learn more. Mr. Butler, welcome back to Mad Money.
Jim, it's great to be with you, and thank you for having me. And can I just also add happy anniversary?
Oh, thank you. Thank you very much. It's big. That is quite kind. Thank you. Okay, so Calvin, if you had told me last year at this time I'd be sitting in front of someone who just had his stock go up 24% and not, I'm not talking about Meta, I'm not talking about Amazon, I'm not talking about Apple, I'm talking about, yes, Exelon, I'd say that's not possible. How could you do it? What did you do?
Well, I would say first, we had a strong regulatory calendar year. We had over 6 rate cases last year in 2024, busiest regulatory calendar year we ever had. And what I can tell you is that the team performed well in partnering with each of those jurisdictions. That's one. 2, I think there was a recognition that there's a partnership with the jurisdictions, but also what we're doing in the economic development for those states and those regions matters. 3, we've consistently delivered and did what we say we were going to do. And that carries a long way. And I was just reading a headline the other day when they said, hey, defense wins championships. You're right here in the Knicks right now. And Exelon's platform, size and scale matters. And we're able to balance a lot of the uncertainties right now and be a stable force in it.
Well, as being a former ratepayer of one of yours, at PECO, the old Philly elect, I can say that things weren't always so convivial. So you must be bringing some level of rigor to them that there's not that kind of fractious relationship that you have with the regulators.
That's exactly right. We always say we want to do this together in a collaborative manner. If you don't want us to invest $1, let's talk about it. But we will provide you the best reliability and best resilience of any utility in the country. And that is what we stand on. And then I think, Jim, it's a recognition that if the utility truly serves as an anchor, we can be part of the solution. And we can balance affordability, reliability, and resilience all at the same time.
Now, you also can be quite a job creator when it comes down to it. Looking for some areas that have had a hard time creating jobs.
That's exactly right. We use the rule of thumb. For every $1 million of investment, we generate $1.6 million in economic output. For every $1 million we invest, we create 7 new jobs. And we do that very intentionally through our workforce academies. We hire from the neighborhoods in which we serve. We have over 90 different workforce programs across our jurisdictions. Last year alone, we hired 2,000 men and women directly with us and with our contractors. We are training people for family-sustaining wages, and they're having careers with us and our partners.
Well, one of the things that I am trying to understand, get my arms around this, because the data centers use a lot of electricity.
Yes.
you've got areas that were originally a lot of manufacturing, some of the areas that have since departed, but you've got great experience with gigantic projects. Your data center business must be really great.
It is, and we really see it taking off in Illinois. On our earnings call yesterday, to your point, we announced over 17 gigawatts of new load coming to our area, the majority of that being in the Chicagoland area. You look at the abundance of land, you look at the reliability and the cost of energy in Illinois alone, you see it. But it's also growing in the other jurisdictions. And what we found is that when you partner with those data centers and understand what they need, we can meet that expectation.
Well, I mean, is it possible that you can become, when I hear the corridor, I usually think about the Pittsburgh area, but maybe your corridor is bigger.
I think what we are providing, when you look at the Mid-Atlantic and Chicago's in the top 5 data center development centers in the country.
Why don't people talk more about that instead of the idea that Chicago's on decline?
Well, it's just the opposite. So when I tell you about that 17 in the works right now, there's another 16 that we're considering and working with them right now. So it's just the opposite. I think Illinois is on the precipice of doing something great, and we're right in the center of all of it.
Well, Kevin, is that natural gas? What are you using? What's the fuel?
Well, the anchor in Illinois is nuclear.
But that is still, that's the other part.
That's the other people.
Right.
And that's not part of us, but that foundation is there. So that clean energy is there. And then what you find with the data centers, they're saying, hey, if we've got a steady flow of power, what can we do to provide backup? But I would tell you what they're really interested in is reliability and resiliency.
Right.
And ComEd is the most reliable utility in the nation according to the benchmarks. That means something to them.
Well, that's what I wanted to ask you about, because to me, I've been following what happened in Spain very closely.
Yes.
They didn't have an anchor like ComEd.
That's exactly right. And we've been working with them as an industry. We're lessons learned. We share information. We still don't know exactly what happened, but we do know it was triggered by some of their generation, large loads of their generation going offline within a couple of seconds. That was the triggering event.
That waterfall that
it did. And it just goes to show you how fragile it is when you're not coordinated and doing the things. This happened to us in 2003, the country, right?
Right.
And we did a lot of things to reinforce. We won't ever say it won't happen again, but I know we're much better off today than we were then, and I know they will be much better off tomorrow than they are.
And I know that they're much better off since you've come in, because I followed these utilities very, very closely. You've done a remarkable job. That's Calvin Butler, President and CEO of Exelon Corp. Take it from me as a former ratepayer. This person has changed things. Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
Am I happy? Because it's the lightning round. Lightning round. Lightning round. Lightning round on Cramer's Mad Money. This is where I take your calls rapid fire. This is where I take your calls rapid fire. Rapid fire calls. Rapid fire calls. One after another. You just say the name of the stock. I tell you whether to buy it or sell it. That's where I take your calls rapid fire. You say the name of the stock. I tell you to buy, sell, sell. I don't know the stock price of the calls ahead of time. Buy, or sell. You know the start of the stock of my Stanford's web. Play to sell. And then the lightning round is over. Are you ready, Ski Daddy? Ski Daddy! Are you ready, Ski Daddy? Booyah, Pop! Booyah! All right. Mark in Hawaii. Let's go to Janet in Colorado. Janet! Let's go to Kyle in Oklahoma.
Hey, hello, Professor Cramer. Thanks for making my life a little happier place to be.
POP. PepsiCo.
Oh, I love that, Booyah.
Super Bowl, Booyah.
I am ignoring that entirely.
This is an exam cramming, ramen noodle eating, college-like Booyah from Colorado State and Fort Collins. Kramer's ice cream Booyah.
You are so hot on all your picks.
Yeah, what do you want?
I want to say thank you for not just the money, Jim, but what the money translates into, in my case, a college education for my son.
They have no respect for when I am talking about a company that I just bought a tuxedo at.
I taught high school for 42 years. If your show was a required part of life skills classes, we'd have generations of financially savvy Americans.
Yeah. Regina, help me. I want to tell that guy who's ringing the buzzer that he is about to be fired if he ever does. Where is he? Come on, come with me. We're finding this clown. Is he back here somewhere? Who is buzzing me? Who is buzzing me? Which one of you? You're all fired. All right, lucky for us, I hired all those people back the next day, and we kept going ever since. Let's see if we can keep the big booyah energy going tonight as we enter our 21st year. And now it is time. It's time for the light round. Quick, by Rafael Road. He's hitting the stock. Buy, sell, stock versus out. My step play this out. And then the lightning round is over. Are you ready? Skiing down to the light round. Quick, I'm going to start with Ian in Florida. Ian.
Hey, booyah, Jim.
Booyah.
Hey, Jim, congratulations on 20 years.
Oh, thank you. Thank you very much. Appreciate it.
Jim, I want to thank you also. I'm an investment club member for all that you do for us as well. Absolutely. Jim, I got a question. So this is about a semiconductor stock that's been kind of beat up this year. Still looks pretty low to me, but I wanted to know what you think about Marvell Technologies.
It's down, its stock is the same price as it was before it got into AI. This is ridiculous. It's below right around where Matt Murphy, the CEO, bought stock back. I bought it personally. I would buy the stock of Marvell, and I'd buy it on Monday. Now I'm going to Dave in Colorado. Dave.
First-time caller, long-term viewer, and club member. The educational section of the club is a gold mine, Jim. It has taught me the importance of a stock's fundamentals. The membership's the best educational investment I've made. Yes. Now I make money, lots more money. I use your phrase, homework, buy homework. With that said, I have a question on ticker OZK, Ozark Bank.
Well, I'll tell you, Ozark Bank, I mean, we look at this, it's not a high-quality bank. Now, you're a member of the club. I think Capital One, COF, when it finishes this merger with Discovery, which is going to be done in 2 weeks, that is the red-hot stock that I think can go much higher. As I said several times today in Twitter, it's the one I really like. Now we're going to go to Phil. Thank you for all the kind words. Let's go to Phil in Florida. Phil.
Hello, Jim. It's a thrill to speak to you.
Thank you,
I want to congratulate you on 20 awesome years, and thank you for what you do.
Oh, thank you. Thank you, partner. Appreciate that. 20 years.
I wanted to get your opinion. I wanted to get your opinion on Applied Digital.
I know the company, and it's the kind of thing, we have so many of these digital infrastructure places. I actually just prefer you, if you're going to go there, just go by Salesforce. I'm not kidding. Go by CRM. I would feel better that way. Let's go to Sonny in Massachusetts. Sonny.
Hey, Jimmy Chill. First of all, congratulations on 20 years. And I want to say a special thank you to your wife and family for allowing them to share us and give us all this knowledge.
You're very nice. That is, Susan. That is very kind. Thank you.
And,
how can I help you?
So, first of all, can you tell me where the Cramer Farm stand is?
Cramer Farm? Pennsylvania. Go ahead. Hello? I think we lost him. We should go to Greg in New York. Greg in New York. Greg.
Hi, Jim. Thank you so much for taking my call.
Thank you.
My question today is about Applied Materials.
Applied Materials, I think, is an excellent company, but I have to tell you, I like Lam Research more, and that's the one I would go for. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Jim Cramer, congratulations on 20 years. I'm so excited for you. You know what? You put in the work. You deserve every accolade that you get. You are Mad Money, and Mad Money is you.
On behalf of the entire Mad Money community, congratulations on this incredible achievement.
Congratulations. I'm so proud of you. Booyah.
What you've accomplished over a 20-year period is quite extraordinary.
We all see how hard you've worked all these years and how clean your mission has been all that time. Congratulations, and I'll see you at work in the morning.
We're only getting better, so don't worry about how old you are.
And I love you, buddy.
Dad, congratulations on 20 years. I am so grateful that you're my father, and I wouldn't have it any other way.
James, I can't believe it's 20 years. 20 years for your show, and happy show.
It's been an incredible 20 years of Mad Money, and I'm so grateful to all the guests who joined us and the staff members who helped us along the way, and of course my daughter and my wife. But we're not done. I still want to talk about two big quarters we saw yesterday from Amazon and Apple. They're just too important to ignore. I don't know a soul who has any other kind of phone. I don't know anyone who isn't a Prime member. It's not easy to get that kind of brand loyalty. It's not easily lost, and both companies, no matter what their stocks are saying, are indeed loved. These are complex businesses, though. Apple has cell phones and wearables, but also has a service revenue stream that matters tremendously because it's sticky and it grows as people get more comfortable with the whole family of products. Amazon's a retailer with an enormous web services business as well as an advertising division that's got incredible gross margins. The complexity does not help the valuations, though. Wall Street loves simple stocks that are easy to get your head around, and these are anything but simple. Last night, Apple reported a very fine quarter, but because of tariffs on goods made in China, this budding consensus is that this was the last good quarter. So the stock cratered, falling $8 to 3.74%. Wow. The tariffs could really play havoc with the numbers. Apple's trying to move enough cell phone production from China to India to get a lower tariff rate, but we have no idea how long it will take to move a significant amount of their manufacturing, so there's a lot of guesswork. We also had a disappointment on the service revenue front, and it comes on top of two lawsuits that can hurt service revenues itself. The Epic suit involving how to pay for downloaded games, and the Monopoly suit that calls into question Google's decision to pay Apple $20 billion for its right to be their default search engine. These legal issues are rough. Put it all together and you can understand why the stock got hit today. How about Amazon? The problem here is that the giant web services business seems to have skipped a revenue beat, with growth declining from 19 to 17%, even as though the margins increased. Now, Amazon stock was able to shrug that off, finishing virtually unchanged, because it could have been avoided if they had more computing power, meaning more chips from NVIDIA. Not all that coincidentally, NVIDIA had a very good week. Apple, no comeback. But it just couldn't make it. I think it could overcome the service revenue miss. It's not like the business has never disappointed before. I also think that any resolution of the lawsuit with Google could be years away, and it isn't clear if the contract can be voided. No, the real problem with Apple is that it's caught in the crossfire of this trade war with China. Right now, I think there are two camps at the White House. The camp that says Apple doesn't deserve this, but CEO Tim Cook will be able to figure out what to do. After all, Apple's created 2.9 million jobs here. About 1.5 million people helped to put together Apple hardware in China. Tim Cook is a champion of the United States and China. He's almost a mystical figure who's managed to straddle these two countries better than anyone. The other White House camp, though, says that China and the United States simply can't be straddled. And anyone who's trying to do that is not a good actor. This camp has a lot of sway with the president. Without a big trade deal with China that effectively rolls back nearly all the tariffs, Apple's earnings are indeed in trouble. Unfortunately, I believe a friendly deal with China, I think, is going to prove elusive. We are choosing to own both of these stocks for our Travel Trust because I believe in them long term. But only one is likely to snap right back, and that is Amazon. Apple, I fear, will be stuck in the penalty box for playing by the rules that our governments endorsed ever since China joined the World Trade Organization in 2001. But that was then with a very different president, and this is now. I like to say there's always a bull market somewhere. I promise I'll find it just for you on Mad Money. I'm Jim Cramer. See you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.